The notification arrives at 6:37 in the morning. You are still in bed, half awake, scrolling out of habit, the kind of scrolling that feels harmless because nothing important ever happens before coffee. But this one is different. It is not a promotion. It is not a news alert about some distant market. It is a message from your mortgage broker. 3 sentences, no emoji, no pleasantry, and the words land like a block of ice dropped directly into your chest. Your appraisal came back. The bank's number is not your number, and the deal you have been holding for 4 years, the pre-construction condo unit you signed on in 2021 with a champagne handshake and a dream about passive income, is now sitting in a gap you cannot bridge with logic, optimism, or the equity you thought you had. You stare at the ceiling, the coffee is still brewing. And somewhere in downtown Toronto, a building with your name on a contract is filling up, floor by floor, unit by unit, with a problem the bank already knew was coming. Welcome back to Canada Property Watch. In our last investigation, we followed the mechanics of the HST self-supply trap, the silent rule inside the Excise Tax Act that reclassified amateur landlords as commercial builders and sent 6-figure tax bills to people who thought they were just renting out a basement suite. Before that, we dismantled the principal residence exemption myth and showed you exactly how the CRA's data matching infrastructure flags property flippers who use the family home as a tax shield. Today, we are going into something different, something with scale, because what is arriving in the Canadian condo market right now is not a correction. It is not a slowdown. It is a supply trap, mathematically constructed, institutionally anticipated, and financially lethal for 3 very specific categories of buyer who walked into it without reading the warning labels. Here is the number you need to understand before anything else. Approximately 20,000 newly completed condominium units are currently sitting unsold in the Greater Toronto Area alone. Not listed, not conditionally sold, unsold, built, finished, registered, and waiting. And behind those 20,000 units sits an additional pipeline of 80 to 100,000 units that broke ground during the construction boom of 2021 and 2022. When interest rates were at historic lows, when investor demand felt unlimited, and when pre-sale absorption rates made developers feel like they were printing money. Those units are coming. They do not care about buyer sentiment. They do not care about rate policy. They are concrete and steel and legally binding completion notices, and they are arriving into a market that no longer looks anything like the market that created them. To understand why this is a trap and not just a slowdown, you have to understand how pre-construction condo economics actually work. When a developer sells a unit in 2021, they are not selling a finished apartment. They are selling a future obligation, a promise to deliver a specific unit at a specific price years from now. The buyer puts down a deposit, typically 15 to 25% spread across multiple tranches, and then waits. During that waiting period, the buyer's financial situation changes, the market changes, interest rates change, and most critically, the bank's willingness to lend against that property changes, because the bank does not lock in your mortgage at signing. The bank locks in your mortgage at closing, and closing is happening right now in 2025 and 2026, in a world that is nothing like 2021. This is trap number 1. The appraisal gap. When a bank appraises a pre-construction unit at closing, they do not look at what you agreed to pay 3 years ago. They look at what comparable units are selling for right now, and in a market flooded with 20,000 unsold units, developers are quietly cutting prices, offering assignment incentives, stacking upgrade packages, and doing everything short of a neon sign to move inventory. Each one of those discounted transactions becomes a comparable. Each one of those comparables compresses the bank's appraisal. And the bank's appraisal is the ceiling on what they will lend. So if you agreed to pay $780,000 in 2021 and the bank appraises the finished unit at $640,000 today, you do not just lose $40,000 in paper equity. You are now required to fund a gap of $140,000 in cash at closing within a legally binding time frame, or You walk away from your deposits and potentially face a builder lawsuit for the difference between your contract price and what the developer eventually sells the unit for on the open market. That is not a hypothetical. That is a clause that exists in virtually every standard Ontario agreement of purchase and sale for pre-construction properties. Most buyers never read it carefully. Most buyers are reading it for the first time right now, at closing, in the same moment they are realizing their broker cannot get them approved. Now stay with me, because this next part changes everything about how you see the rental market. Trap number 2 is the conversion cascade. In an attempt to address Canada's chronic housing shortage, various government programs have incentivized developers to convert unsold or stalled condo towers into purpose-built rental buildings. On the surface, this sounds like a policy solution. In practice, it is a mechanism that eviscerates the investment thesis of every landlord investor who bought a pre-construction unit expecting to rent it at a premium. Here is why. When a converted tower enters the rental market, it does not enter quietly. It enters with hundreds of units simultaneously available, a professionally managed, institutionally backed, and priced strategically to achieve occupancy, not profitability. An institutional landlord with 1,000 units can afford to rent 50 of them below market for 6 months to establish occupancy and lock in financing. A private investor with 1 unit cannot absorb that same discount without bleeding cash every month. So what happens is mathematically brutal. The institutional supply pushes average rents down in the immediate submarket. The private investor, who bought the pre-construction unit expecting $1,200 per month in positive cash flow based on 2021 pro forma numbers, is now staring at a rental rate that covers maybe 60% of their carrying costs. They do not exit immediately. They hold and they bleed, and they start using credit to fund the gap. And credit, as we are about to explain, is the third trap. Which category do you fall into? A. Investor holding a pre-con unit. Or B. Homeowner with a HELOC you use to fund a down payment. Trap number 3 is the renewal and HELOC compression. Let us talk about the mechanics of how this executes. A significant number of condo investors in the 2020 to 2022 cycle did not use savings for their down payments. They used home equity lines of credit, HELOCs, drawn against the appreciated value of a primary residence or an existing investment property. At the time, this was rational. Prime rate was under 2%. The HELOC carried a variable rate that felt manageable. The projected rental income on the new unit looked strong. The math worked on a spreadsheet. The math does not work anymore. Prime rate moved dramatically from its historic lows, and HELOC debt, which is entirely variable, repriced in real time, month by month, with every Bank of Canada decision. An investor carrying $200,000 in HELOC debt at what used to cost them $300 a month is now carrying that same debt at a materially higher cost, while simultaneously watching their rental income fail to cover the condo's own mortgage, maintenance fees, and property tax. This is what financial analysts call negative cash flow stacking. It is not a theoretical stress scenario. It is the current operating reality for a statistically significant cohort of Canadian condo investors right now. And here's where the bank enters the picture, not as a lender, but as an algorithmic enforcement machine. Under the Office of the Superintendent of Financial Institutions, Guideline B20, federally regulated lenders are required to stress test borrowers against rates materially above their contract rate. When a mortgage comes up for renewal, and hundreds of thousands of Canadian mortgages are renewing right now in the largest renewal wave in modern Canadian history, the bank does not simply roll the loan. The bank looks at the property's current performance. They look at rental income documentation. They look at the borrower's total debt service ratio. And if the numbers have deteriorated, if negative cash flow has eroded the debt service coverage the bank originally approved, the renewal is not automatic. The bank can decline to renew on the same terms. They can demand a full requalification. And in cases where the borrower's financial position has materially changed, the bank can invoke provisions that reduce the available credit on the HELOC itself, compressing the borrower's liquidity at precisely the moment they need it most. This is not a theoretical scenario the bank is discovering in real time. The bank modeled this. The bank's risk department saw the supply pipeline numbers 2 years ago. The bank knew that 80 to 100,000 units were coming to completion in a compressed window. They did not tighten lending standards because of this week's news cycle. They tightened because their actuarial models told them that a flood of supply into a softening demand environment would produce exactly the appraisal gaps, the rental rate compression, and the cash flow deterioration that we are now describing to you. The bank moved first. That is the title of this video. And if you are only hearing about this now, you are not early. You are late. Let us talk about who gets hit first in order of financial fragility. The first casualty is the young professional buyer who purchased a pre-construction unit as their first home in 2021, convinced by a sales agent that the market would make them wealthy before closing. They are not an investor. They are not a speculator in the predatory sense. They are someone who saved diligently, stretched aggressively, and is now facing a closing gap they cannot fund and a mortgage they cannot qualify for at today's rates on a unit that is worth less than what they agreed to pay. Their deposit, sometimes representing years of savings, is at risk. Their credit is at risk. And there is no government program that vaporizes the legal obligation they signed. The second casualty is the leveraged multi-property investor who assembled a portfolio between 2018 and 2022 using a BRRR-style recycling strategy. Buy, renovate, refinance, repeat. Each refinance pulled equity from one property to fund the next purchase. The strategy worked beautifully when property values appreciated 15 to 20% annually. It becomes a catastrophic chain reaction when values stagnate or decline, because the entire leverage stack was built on the assumption of continuous appreciation. Remove that assumption, add negative cash flow from multiple properties simultaneously, add HELOC repricing, add renewal scrutiny, and you do not have a financial challenge. You have a synchronized detonation of every assumption the portfolio was built on. The third casualty is the homeowner who used a HELOC as a revolving credit card against their primary residence. Not to invest in property, but to fund lifestyle, renovations, vacations, or a child's education. And who now faces a HELOC product that is being revalued downward as the lender reassesses the property's current market value. This person thought they owned equity. They did, on paper, at a moment in time. As the condo flood suppresses prices in urban markets and the comparable transactions around them soften, the equity the bank recognized 2 years ago becomes the equity the bank is no longer willing to lend against. They do not receive a warning letter first. They receive a revised HELOC limit. And if they have been living partially on that credit, the compression is immediate and it is personal. Drop a comment below. Tell me, ME plus the year you bought your condo or signed your pre-con agreement. I want to see exactly which wave of the pipeline we are dealing with in this audience. Now let us talk about the collateral damage to the people who did nothing wrong, because this is the part that the financial press consistently underreports. When a distressed condo investor is forced into a fire sale, when they cannot close on a pre-con or cannot sustain negative cash flow, or cannot refinance at renewal, they do not simply disappear from the market. Their distressed exit transaction becomes a comparable. It becomes the data point that the next appraisal is measured against. It becomes the number the bank uses when your neighbor tries to refinance their own mortgage. The investor's catastrophic exit mathematically depresses the equity of every person within the same postal code who had nothing to do with the speculation, the leverage, or the decision to ignore the warning signs. This is not theoretical. This is how real estate markets have functioned in every supply-demand dislocation in recorded history. The innocent absorb the collateral damage of the reckless. And in the current environment, where the supply pipeline is measured in the tens of thousands of units, that collateral damage is not going to be contained to one building or one neighborhood. It is systemic. Here is the checklist. 5 things you must verify right now before you make any decision to buy, hold, or sell a condo in the current Canadian market. First, check your maintenance fees and the reserve fund status of your building. A building with an underfunded reserve is heading toward either a special assessment, a sudden mandatory cash call to every unit owner, or deferred maintenance that will further suppress resale value. Request the status certificate. Read it. Understand what it says about the building's financial health. Second, verify whether your unit's layout and specifications match current rental demand. Investors who bought bachelor units or ultra-small one-bedrooms in 2021 are discovering that the tenant pool for those configurations has shrunk while the supply of identical units has multiplied. Layout demand is not uniform across the market, and your pro forma assumptions about occupancy rates may not survive contact with 2025 reality. Third, pull actual rental comparables from your building and the 3 buildings nearest to yours right now. Not from 2023. Not from a broker's marketing package, from current active listings and recent lease transactions. If those comparables show rental rates materially below what your carrying costs require, you are not holding a cash flowing asset. You are funding a liability with the fiction that things will improve. Fourth, understand your appraisal buffer. If you are renewing a mortgage or planning to refinance, determine what price decline your equity position can absorb before the bank's loan-to-value ceiling triggers a required paydown. Most investors have not done this calculation. The bank has. Fifth, and most critically, and thus know exactly what happens at your next renewal. The date, the rate environment you will be renewing into, and whether your debt service ratios, using current income and current rates, would pass a fresh qualification today. If they would not, you are not managing a mortgage. You are managing a countdown. The myth that must be destroyed before we close is this, that handing the keys back solves the problem. In Canada, mortgages are recourse in most provinces. When a lender sells a property through power of sale and the proceeds do not cover the outstanding mortgage balance, which in a distressed flooding market is increasingly likely, the lender pursues the borrower for the deficiency. This is called a deficiency judgment, and it does not expire with the transaction. It attaches to the borrower's credit record and can result in wage garnishment through the courts. For investors who committed any form of material misrepresentation in their original mortgage application, income inflation, occupancy declarations, undisclosed debt, the consequences escalate significantly. CMHC, which insures a large portion of Canadian residential mortgages, maintains its own records of fraud findings. A confirmed fraud finding does not mean you cannot get a mortgage somewhere else eventually. It means that the pool of institutions willing to lend to you, at any rate, for any purpose, becomes catastrophically small. You are not temporarily locked out. You are structurally excommunicated from the institutional lending system. There is no bankruptcy strategy that cleanly resolves a CMHC fraud flag. There is no credit repair program that erases it on a timeline that matters to your financial life. It is a permanent record of a permanent decision made under temporary optimism. The condo flood is not a metaphor. It is a supply-side mathematical reality backed by construction completion data, absorption rate modeling, and lender risk policy that has already been written, approved, and implemented. The institutions moved first. They always do. The question is whether you are moving now, with information, with a checklist, with a clear-eyed assessment of your actual financial position, or whether you are waiting for confirmation that will arrive in the form of a closing notice, a renewal denial, or a revised HELOC limit that makes the situation real in the most personal financial way possible. This channel exists because the gap between what the institutions know and what individual property owners know is not accidental. It is structural. The system does not send you a memo when your equity is at risk. It sends you a notice when the decision has already been made. Our job is to close that gap, one investigation at a time. Next, we are going into the appraisal trap in granular detail. We are going to show you exactly how a bank-ordered appraisal is conducted, how the comparable selection process works, how an appraisal can come back $40,000 to $100,000 below your expectation through entirely legitimate methodology, and what your legal options actually are, which are fewer than your broker is telling you. The appraisal is not a number. The appraisal is a weapon, and in the next video, we show you how it is aimed. Subscribe now and turn on notifications. The next wave of closings begins this quarter. What you learn in the next 48 hours may be the most financially relevant information you encounter this year. Vote below. Do you want us to go into the appraisal mechanics next, or the power of sale timeline and what really happens after the bank takes your property? Comment A for appraisal, B for power of sale. Your vote determines what gets built next.